Yeah, we're going to get started right on time. Great to see such a nice turnout. Um, a little belated Happy New Year to everybody. And Jerry, why don't you get us started?
Sure, sure. Great. So a few notes on kind of what we're going to talk about today. Going to spend a few minutes, obviously at the top of the call, spending a little bit of time on some things that are top of mind for us. Um, spend a little bit of time on a change that we made over the summer that we're really excited about. A little bit about tax loss harvesting to kind of string a thread through some of the pieces that we've been sending out, and going to spend a little bit of time on ETFs, which are top of mind always for us, but certainly top of mind most recently for a couple reasons. Then we're going to talk about something that we're really, really excited about, which is a change to our trading software that James has been hard at work on. That is, I think, really beneficial to everyone on this call and a lot of other folks as well. But the majority of the call is going to be spent on questions, and so we've gotten a ton of questions from a lot of you before this, but as questions come up, feel free to drop them in the chat or raise your hand and we'll pull people off mute to ask questions to the group once we kind of get through some of the prepared questions that we started with. And then we'll finish up with a few things that we are excited about over the last few weeks and months, kind of on the press and the press side of things and kind of the attention that we've been getting, which we're really excited about. So with that, I'm going to throw it over to Victor to talk about PCAPE.
So, this is something that we wrote about and we've been in touch about since around the middle of last year. And basically, we've been using the cyclically adjusted earnings yield of each broad stock market as what we've always said is the best simple predictor of the long-term real return of that stock market. And, we always want to keep things as simple as possible, as transparent as possible, so everybody can follow what we're doing and kind of own it and be comfortable with it. And so, we were hesitant to make any changes to this Shiller, this kind of standard conventional Shiller measure of adjusted earnings, where we adjust for um, basically inflation going back over the last 10 years. But we did think that it was worthwhile in the end. We did a lot of soul searching and research and decided that it was worthwhile to take account of the fact that companies and more recently this has been the case, the companies retain a lot of their earnings, don't pay them out as dividends, retain them, and basically are reinvesting them in the business in order to grow their earnings and take advantage of growth opportunities. And so when you look back over the last 10 years, it makes sense to make an adjustment when you're looking at earnings from 10 years ago to realize that if I'm going to bring those to today by inflation and adjust and average it together to get like a base level of earnings for the stock market, that I should grow them at an equity kind of return over that period, the amount of the earnings that were not paid out, which were retained. So we've added that to our measure. The result of that is it leads to a higher expectation for long-term real returns for all the stock markets, because in all the stock markets, companies are retaining earnings. The U.S. companies retain the most earnings of everybody else, but at the same time, their earnings yield is the lowest relative to the rest of the world. And but in all cases, this adjustment led us to believe that equity returns would be higher. It had us increase our equity exposure uh, somewhat during 2024 as we put it into production. And when you see our capital market assumptions that we're sending out every 3 months now for people to be able to really focus and see what we see as expected returns for stock markets and the level of interest rates that's relevant to that. Um, that includes our PCAPE measure, now this payout adjustment measure now. So anyway, just wanted to review that briefly. I'm sure everybody's sort of heard about that, but we're excited about this idea of getting these capital market assumptions out there. As we've said before, it's the most important number for investors is to know what the earnings yield is of the stock market or what the expected return is of the stock market. And you can open up a Wall Street Journal or the FT or Economist, and you'll never find it at the moment anyway. That it's never shown in there. So probably one of the most important numbers we need as investors is not out there. But anyway, we're publishing it every quarter, which seems frequently enough. So I'll stop there and back to you, Jerry, for the next topic.
So, yeah, this is something that we're excited about for a lot of reasons. I think that one of the things that we've seen, and this comes up in almost every conversation when we're talking with U.S. taxable investors, clearly there is a massive push in the sort of wealth management industry to push these various different strategies around tax loss harvesting, and the standard pitch is obviously very compelling, right? Who doesn't want to pay less in taxes? We have sort of termed this as the tax avoidance distortion field, and what we're seeing is that there are a lot of sort of ideas that are dangled as ways to avoid paying taxes, where the sort of costs, the risks, the complications, in our opinion, far exceed the benefits of a lot of these programs. And so you'll notice that we are continuing to bang the drum on this. We published on it last week. We published on it earlier or later in 2024, and we'll probably continue to talk about it a lot, and how we think that our approach is a bit more sensible for almost all, like I said, taxable U.S. investors. James recently rolled out a really fun calculator that we have on the website that allows people to kind of visualize how we might recommend selling down a highly appreciated position. Would recommend people who are sort of in this situation, and I imagine it's quite a few of you, to take a look at that tool and certainly reach out to us to talk a little bit more about how that might fit into your own portfolio, and how that might be more appropriate than some of the things that other people in your financial picture may be pitching you as an opportunity to kind of let that tax tail wag the investment dog, as we like, or the asset allocation dog, as we often say around here. So very top of mind for us, as I'm sure it is for a lot of you, and would be happy to kind of talk more about these things as you're weighing the different ways that you may be looking to deal with these unique tax situations that I'm sure many of you are sort of facing and thinking about right now.
Let me just say a few words about ETFs. Almost 10 years ago, we wrote a piece on why we thought that ETFs were really an underappreciated investment structure. And in one of these talks, I think I introduced the idea of saying that ETFs are to mutual funds what the telephone was to the telegraph. And I'm sure a lot of you know in the history of the telephone that when the invention of the telephone came along, like the first thought of the telegraph companies was that they were just going to have that they were going to do telegraphs by phone. So you'd call up the other person and read a telegraph message to them, and the and potential of the telephone was really underappreciated tremendously at the time. And I think that the same thing holds with ETFs. They're just such an improvement over mutual funds for a variety of reasons. And we talk about this from time to time, but we just thought it's worth circling back and reviewing some of the mechanics of ETFs. Obviously, ETFs are the main components of all of the portfolios we manage for U.S. and non-U.S. investors, and we're in the process of launching our own ETF structure ourselves. I think a lot of the first thing that a lot of people have thought about with ETFs is, oh, these are great. I can buy and sell them during the day instead of with the mutual fund that I have to only trade, or I'm only allowed to trade them at the end of a day at the closing prices, as opposed to being able to take advantage of having liquidity in the ETF all day long. And yes, that is a benefit. We don't think that's a really big benefit, but it's a benefit for sure. I think that one of the benefits that we think is really big is the fact that the ETF structure puts the cost of subscriptions and redemptions of money coming into or out of the ETF and the transactions costs that are associated with that, it puts those costs onto the people that are putting money in or taking money out of the ETF. As opposed to in a mutual fund, you put your money in, and the mutual fund has to go out and buy everything that's in there so that it's invested properly with the new money that came in. And the transactions costs associated with that are spread out across all the existing investors in the mutual fund, even though they didn't do any trades. There are also some really nice cost benefits to an ETF and a mutual fund, whether US or non-US mutual funds. The mutual fund has to keep track of all the investors, and the record keeping is more costly and complicated. And hence, in general, you always see mutual funds with higher fees than the equivalent ETFs as a general matter. And then we have the tax benefits. I want to spend more time on that. In just a second, we'll go to a slide to talk about the tax benefits a little bit. We'll focus on US ETFs for that, and then also a few comments on non-US listed ETFs. But before we go there, I just wanted to, I think everybody knows that we're converting our private fund, which was the very first thing that Elm launched in 2011, was a private fund for investors. It was, that's what I invested my family's savings in, and all of our early investors. That was the only thing we had, and everybody was investing in that. So it's been around for 13 years. In the last 5 or 6 years, all of our new investors have basically been investing via separately managed accounts, or in the case of non-US investors, in our offshore fund. And so this original private fund for US investors has gone along and done quite nicely. And we felt that there was an opportunity to convert it into an ETF, and that there were a bunch of benefits for the investors in the private fund if we did that conversion. And all of our private fund investors were basically in favor of the conversion. And the ETF is going to start trading next week. You'll hear news about it. For those of you who are non-US investors or invested in our separately managed accounts, you'll be hearing about this, and we just want to make sure everybody knows we've been talking about it, but we're really excited to have that. And so let's just talk. I want to talk a little bit about the what are the tax benefits of US listed ETFs. So let's go on to the next slide now. And because I think that I often talk to people like myself who have been in finance for 40 years, and when I ask people if they know how this ETF mechanism works that gives it its nice tax efficiency, people aren't so clear on it. And we've been just immersed in this for such a long time that there's the curse of knowledge. It all is like, oh, so we know about that. But I just thought it's worth trying to go through it a little bit more slowly so that everybody gets a chance to internalize it. So we're going to just take a really simple example. Imagine there's some ETF out there, and the only thing this ETF owns is Microsoft stock. So we're just making up an example for simplicity to get the idea across. So this ETF, it's been around for a while. It owns, say 1 share of Microsoft stock, and the value of that Microsoft stock is $100 in today's market. But it bought the Microsoft stock long time ago for $10. So it has there's an unrealized gain inside of the ETF of $90 of unrealized capital gain. And so if for some reason the ETF wanted to sell the Microsoft stock and buy some other stock, it would realize a $90 capital gain, and it would have to distribute that, report it, and distribute it to the holders of the ETF. And even if the holders of the ETF weren't selling anything, weren't selling their shares of the ETF, they would have this gain that they would have to pay tax on and raise money to pay tax on. But let's say now some new investors come along and they want to buy shares of this ETF. It was what's called a creation. So the ETF is going to increase in size because a new investor comes along and wants to buy 50 shares of the ETF. Let's say there's 100 shares outstanding. They want to buy 50. And so the way it works is that effectively they, through an authorized participant market maker like Jane Street, they will basically be giving $50 of Microsoft stock into the ETF and taking back 50 shares of the ETF. So after that happens, the ETF will now hold $150 worth of Microsoft stock. There'll be 150 shares of the ETF outstanding. And the cost basis will still be $10 on that $100 worth of Microsoft, but the $50 came in at the market level, and so its cost basis is 50, and there's no unrealized gains there. So okay, so now we've got a $150 ETF, still with $90 of unrealized gains. Now let's say that the next day, on day two, somebody wants to redeem out of the ETF. So they say, I want to sell 50 shares of the ETF. I want to redeem. So in this case, the way that works is that we're going to give $50 of Microsoft stock to an authorized participant, say Jane Street, and they're going to give us 50 shares back of our ETF. So there's only going to be 100 shares of the ETF outstanding. But the $50 of Microsoft that we give them, we're going to give them the tax lot that had that $10 basis. We're going to give them half of that whole tax lot, in fact. So we're going to now be left with $50 worth of Microsoft stock that has a $5 basis because we got rid of half of it, and then $50 that has a $50 basis. So the ETF is back to 100 shares, $100 of value, but instead of having $90 of unrealized gains in there, now it has $45 of unrealized gains. And this creation and redemption process of people investing in our ETF and taking money out of our ETF over time, will allow us to manage unrealized gains and reduce unrealized gains within our ETF, hopefully, as well as doing our own tax loss harvesting and tax management. And hopefully that's going to be a really good way for us to do our dynamic index investing, where we are sometimes selling things that have gone up and otherwise we'd be realizing gains. But within the ETF structure, we hope that we're going to have very low realized amounts of capital gains over the long term and allow investors to benefit from a dynamic asset allocation while at the same time not getting burdened with capital gains taxes over time. And of course, when you eventually sell the ETF, you'll pay a capital gain. There's no that all that's happening through this is kind of a fair treatment of capital gains rather than the acceleration that you would get if it was in a mutual fund structure. So anyway, just thought it was kind of interesting to show how that works. It turns out that ETFs that are listed in Europe or outside of the US are very tax efficient without any of this. In fact, that an ETF listed or an ETF that's domiciled in Ireland or Luxembourg and listed on the London Stock Exchange or elsewhere in Europe or outside of Europe doesn't have capital gains distributions at all. So none of this is kind of relevant to those ETFs, but those are really tax efficient for taxable investors outside. So if you're a UK taxable investor, that you're not going to, and you own an ETF, say an ELM ETF or any ETF for that matter that's listed outside of the US, that's listed in Europe, there won't be any capital gains coming your way through the ETF, which is also a nice feature of ETF. So, I think that all these benefits of ETFs, or why what we're seeing is this continued explosion in the amount of assets globally in ETFs and a shrinkage almost in the same amount in traditional mutual fund structures. So there's just this huge migration that savers are putting their money into ETFs and taking their money out of mutual funds. And all the main investment managers are kind of following this trend. The U.S. is completely leading the way. That the assets and volumes and everything are an order of magnitude or more bigger than outside of the US, but outside of the US, things are really moving in that direction and will continue to grow and accelerate too. So anyway, if you have any questions about ETFs at all, feel free to be in touch with us. We're always happy to kind of share our understanding and to learn more as well. We've been learning a lot in the process of creating our own ETF for the Elm strategy.
So we a lot of time in 2024 working on some significant improvements in our portfolio management tools. And to take you back to kind of the history of this, our first portfolio management system was a sophisticated, customizable tool called Microsoft Excel. And that worked pretty well when Elm was really just managing one fund and then a very small number of separately managed accounts. But as we scaled the separately managed account business, we internally developed a dedicated portfolio management system around 2017. We called it Ulmus because Ulmus is the Latin genus for the elm tree. It was great, and it allowed us to individually rebalance all of our separately managed accounts at the tax lot level. Taking into account the trade-offs between going right to our portfolio targets, wanting to be tax efficient, wanting to be transaction cost efficient, wanting to do tax loss harvesting, etc. But all things come to an end, and in 2024, we replaced the first generation of Ulmus with the second generation of Ulmus. It was a project we were working on throughout the year. Some of the benefits of Ulmus 2.0 accrue to us as a manager. We now manage almost 1,000 separately managed accounts, between Fidelity, Schwab, and JP Morgan. And we needed some upgrades to the tool to make it more efficient for us to manage that number of accounts. And some of the benefits accrue to our clients, in particular, when it comes to allowing us to much more flexibly support taking in appreciated assets in kind. So historically, if people had a big position in Apple or Microsoft or one or two stocks that they wanted to incorporate into their Elm account, we sometimes would be able to accommodate that, but only for a very small number of positions. Now we're able to take virtually unlimited portfolios of assets in kind, as long as they are listed assets that we can trade electronically. So we can't take privately held funds and things like that. But virtually any stock or fixed income instrument or instrument that we can trade at Fidelity or Schwab, we can now take portfolios of, I think the largest portfolio we've taken has almost 700 names in it, and incorporate those into your Elm managed account in a tax efficient way. And one of the things, if you want to do that we'll look at with you, is a graph like the one you see here, which shows the possible trade-off curve between tracking error and realized gains. So let's say somebody has just given us a portfolio of 500 appreciated stocks, and curve shows tracking error on the x-axis, where the definition of tracking error is how much deviation we expect from the actual account returns to the returns of our target portfolio. So if you're at the far right end of this graph, it's about 1.6% tracking error. That means that If you hold that portfolio, which is basically us doing just taking the assets in kind, with almost no rebalancing, or with only the rebalancing that wouldn't realize any gains, then we would expect in a typical year there would be a 1.6% return difference between your portfolio, your actual portfolio, and our target portfolio. On the other hand, if you look at the far left side of the graph where it's almost 0% tracking error, but to get there, to rebalance the portfolio to close to 0% tracking error, we would have to realize $60,000 of gains in this case. And you can see that, we can get to about 0.6% tracking error, realizing very little gains, and then getting closer, getting down to zero starts to have a much steeper cost. So we can now very easily run this type of analysis for an arbitrary portfolio of in-kind assets. And then once we choose where on this curve you want to be for the initial rebalance, going forward, we can also accommodate tax preferences to a very high degree of detail. So clients can tell us, your marginal short-term and long-term tax rates. You can tell us the trade-off, how you think about the trade-off between capital gains and tracking error, and we can permanently incorporate that into how Ole Miss will rebalance your account going forward. We're going to write about all of this in greater detail in our first quarter letter. So you'll be reading more about this soon, within a few months. But this is a feature. The ability to take assets in kind of en masse is a feature that a lot of clients have already availed themselves of, and that we feel like there's a lot of demand for. And we feel really good about being able to reasonably incorporate those kinds of portfolios into your Elm portfolio.
Fantastic. Thanks, James. I'm gonna ask you to keep the microphone for a second and kick off our Q&A here. This first question comes from Ken, and we've, as you probably would guess, we've gotten a lot of questions in this vein. Specifically, do Elm's risk premia and risk level metrics take into account the effects of things like government imposed tariffs? And just generally, how do we think about those types of things influencing the signals that our portfolios are reacting to?
Yeah, so long-time Elm followers will be shocked to learn that the answer is yes and no. Do, in a sense that Elm's risk premium and risk level metrics are primarily based on market prices. And while we certainly don't believe that markets are perfectly efficient or that markets always get it right, which is not the theory of market efficiency, we do believe that broad markets are pretty efficient when it comes to discounting widely available public information. And so to the extent that both the known elements of tariff policies and the uncertainties of tariff policies are something that is widely known about and discussed in markets in the world, you would expect market prices to better reflect views about that than any one particular person's view. So to the extent that our risk premium metric is primarily driven by market levels, and our risk level metric is implicitly driven by the volatility of equity prices. They both incorporate information about the entire macroeconomic landscape, tariffs and everything else. The way in which these metrics don't incorporate it is that Victor, Jerry, and I don't sit around at night talking about tariffs and figuring out, how it should influence market prices. And we think that's a good thing for all of our investors. One of the lessons of being a long market follower, I think, is that figuring out how to map economic and macroeconomic information onto market information about short-term or long-term returns is fiendishly difficult. And, the market does a much better job of that than we could possibly do personally.
Great. Thanks, James. This is a similar vein, Victor, Jake asked us a question about just generally how to think about our momentum signal. How do we evaluate it? How do we think about it as a kind of predictive of future market movements? If you could speak a little bit about your perspective on the momentum signal, its validity, its viability going forward, and why we continue to kind of like that as a main feature of our portfolios.
We get so many questions on that. So it's always good to talk about it. Also, Jerry, maybe after this question or sometime, I think there's a bunch of questions in the chat that will have really short answers as well. But anyway, let's talk about momentum for a few seconds. So, I think that we we talk about the momentum metric that we use as primarily being a signal of risk, that when momentum is positive, when the market is higher than it's been over the last 12 months, adjusted for inflation and total return and all that, that tends to be a low risk environment where volatility is relatively low. And when momentum is negative, that tends to be a higher risk environment where markets are bouncing all over the place as they were, say, during COVID in the beginning of 2020. And so we're using this as a risk metric, or talking about it as a risk metric. And of course, people say to us, well, why are you doing that? Why don't you just measure risk directly? You've got an options market on all these different assets that you can look at implied volatility. You can look at near-term realized volatility. And that's true. Maybe we should have gone for some kind of a direct volatility metric rather than momentum, when we were setting up Elm. We have an aversion to making big changes to what we're doing. But at the same time, we really like momentum. I think that we probably would have made the same decision, if we started over again, notwithstanding, all the questions that we get about it, because we think that momentum really is a great risk metric and has a lot of nice properties to it. So if we were going to use a risk metric directly, by measuring market volatility, we'd have to make decisions on all kinds of other things at the same time. We'd have to basically do like a post-measurement processing of this risk metric if we were using market volatility, because we wouldn't want to have so much, that if we were just using some metric directly from the market, the volatility moves around every single day and moves around really dramatically. So if we weren't going to do some kind of post-processing on it, we would have a tremendous amount of trading volume and changing of positions that would be coming from this very volatile metric of looking at market volatility. If we wanted to use a long-term options market signal, like we're going to use 5-year options to try to measure that, well, we kind of know from experience that the 5-year equity options market is very illiquid and is much more driven by technical supply and demand movements than it is from people really thinking about what long-term volatility is. So we really like momentum for those reasons. I think that maybe some of you will remember a research note that we wrote quite a while ago that I think is one of the real interesting puzzles in finance, which is that probably the best signal for changing asset allocations is momentum, whether it's a risk signal or used as a return signal. In either case, if the only thing that you did as an investor was change your asset allocation based on momentum being positive or negative, in almost every asset class, from equities to natural gas to Bitcoin to long-term bonds, whatever, you would have done really well over the last 100 years or whatever period these assets existed. So I think a lot of people feel that the momentum signal is probably the most valuable signal that we have in terms of asset allocation. But at the same time, people also realize that return chasing is probably the original sin in investing, that moving your investments based on historical returns, going into what's hot, dumping what's cold, is like the worst thing that you could do. But these two things, they sound like exactly the same thing, that momentum and return chasing sound like exactly the same thing. So how could one of them like be the best thing you could do and one of them be the worst thing that you could do? And we wrote about this. I think we're still scratching our heads over it. Momentum investing, using momentum is a very well-defined thing. So we know exactly what it is, and we know that it works. We know that when momentum is positive, it tends to be when markets are quiet. So it sort of is also serving this purpose as a risk metric. But return chasing is not such a well-defined thing, although we do know that various forms of it really are a detriment to investor outcomes. So anyway, I hope that kind of answers the question and also maybe leaves a little bit of curiosity and thinking about it. As I say, we've written about it, and we'll probably wind up writing about it again when we collect more of our thoughts on it. But anyway.
I'll give you both a chance to catch your breath a little bit and answer some of the ETF questions in the chat. So, we're definitely interested in looking at a European listed ETF. We're very, very early in that process. I'll be really, really mostly focused on our ETF in the US. And we've sort of talked about this with other people outside of Elm, but one of the main reasons that we're able to do this conversion of the private fund is the cost environment has changed dramatically in the US, as Victor touched on a bit earlier. We're still exploring if that's also true in Europe. Early indications is sort of maybe, but we're learning more, and we obviously like the structure a lot, so we're excited to kind of keep kicking the tires on if that's realistic. And then the management fee. So at launch, the management fee, the kind of listed management fee, will be 24 basis points, and so 20 of that is Elm's management fee, and then the 4 basis points will be the underlying expense ratios of the funds that we hold. And then that's actually down a little bit given Vanguard's announcement recently about their overall lowering fees. So we're encouraged by that, and so that's the listed fee there.
Jerry, can I just say, and the 20 basis points, so 24 is the total expense ratio, which includes the underlying ETFs that we invest in. But the 20 basis points of the management fee that Jerry mentioned, depending on how you look at it, like half of that is going to expenses to run the ETF, to the custody and dealing with US Bank that's helping us, the US Bank Corp, which is helping us to do this. So we haven't raised our fee to 20 basis points from 12 basis points that we were charging. Again, depending on how you look at it, we're getting, at this level of the fund, we're getting less in fees than we were in the fund or whatever. But a lot of the 20 basis points right now is going to US Bank. As the ETF, if the ETF hopefully gets bigger, the balance will change. And if it gets big enough, we anticipate that we would be able to reduce fees as well. So anyway, but just wanted to clarify that.
Do we, James, actually, do you want to take this question about, and maybe speak more broadly on the ETF versus the separately managed account offering? Like what, how we are thinking about that, and just generally our thoughts on the difference between those two places.
Yeah, so we anticipate that most of our separately managed account investors will want to stay in their separately managed account. Um, there are some advantages the ETF has. In particular, the ETF in some cases can be more tax efficient, modestly more tax efficient than the separately managed accounts can, because of the create redeem structure, Victor was talking about, that allows less capital gains to be realized on trading. But that said, the SMAs are already quite tax efficient in realizing very little, if any, short-term gains. We work quite hard to do tax loss harvesting to limit the long-term gains. That's a lot of what Ole Miss is doing in the separately managed accounts, um, is trying to rebalance the accounts in such a way that keeps them pretty close to our portfolio targets, but also in a tax efficient way, and getting as much tax loss harvesting as we can. Um, there are, but there are a lot of reasons to be in the SMAs that that the ETF can't accomplish. So in the separately managed accounts, our clients can change these dial settings to customize the account, for the amount of equity risk they want to take, for the mix of US versus non-US equities, for how dynamic they can get. And you can't do that in the ETF. You can give us assets in kind to the SMAs, and we'll incorporate that, in a way that isn't possible in the ETFs. We're available, Victor and me and Jerry and our staff are available to talk to our separately managed account clients, um, and help with financial planning exercises and all kinds of things that um, that we can't be for people who are just ETF investors. Um, our real hope for the ETF is that uh, we're very likely to in the near future raise our separately managed account minimums for new clients. We already have a 1 million minimum for separately managed accounts, and but we very regularly encounter people who like how we invest, want to invest with us, but want to invest $50,000 or $100,000. And, for people who are family members of existing investors, we always try to take family members, but we can't really take new clients, in our kind of private client business, for $50,000 or $500. But, people can invest at any level in the ETF. So it really broadens um, our ability to invest for a lot more people. Victor, did I miss anything major on the comparison?
I'm answering a few questions in the chat. I'm typing. I hope nobody's hearing my typing.
Victor, actually, but sort of changing gears slightly. This is a question from Mike. Can you talk a little bit about the fixed income portion of the portfolio, specifically why cash has been going up so much versus tips, and just generally how we think about the fixed income allocation bucket? Obviously that's been top of mind for a lot of folks recently, and got a few questions on this, but I think it would be good for just to kind of to surface that as something for people to think about.
So for all of our products for U.S. investors, basically the fixed income bucket starts off looking like 40% bills in the baseline allocation, 40% bills, 40% tips, and 20% split between munis and an aggregate nominal bond index. In non-taxable accounts for U.S. investors, we don't have the munis in there, and it's just the aggregate bond index. So that's the starting point. In the asset allocation, first we decide how much equities do we want to own in the fund or in separately managed accounts. How much equities do we want to own? And assuming that's less than 100%, the rest of it is in fixed income. So we wind up with some amount in fixed income just from the residual versus how much we want in equities. So let's say that's that we have that's 40%. Maybe we want to have 40% in fixed income and 60% in equities, because equities are either some combination of offering relatively low returns relative to safe assets, and or have heightened risk. We're in a negative momentum, high risk environment. So that 40% in fixed income, right, it would be split. The baseline would be 40% bills, so 16% bills, 16% tips, and then 4% each in the other two buckets. But then we look within the fixed income bucket and we say, we're going to apply this risk metric, this momentum metric, to also overweight or underweight the buckets within fixed income that are not treasury bills. So we look at TIPS and we say, do they have positive or negative momentum? If they have positive momentum, we give them an extra boost within the bucket, or we decrement them if they have positive momentum, if they have a negative momentum, and the same for the nominal bonds. So we're trying to do a little bit of dynamic asset allocation within there. And so recently, interest rates have kind of been drifting up. This positive trend in fixed income markets, came to an end and stabilized and has even dipped down. And so, TIPS and nominal bonds have moved from having positive momentum, like maybe 6 months ago, to neutral and then negative momentum more recently. And so treasury bills have been going up within the bucket, bills have been going up, TIPS have been going down, but also the whole fixed income bucket has been getting bigger because we've been decreasing exposure to equities a bit over the last few months, as well as things have been shifting there. So that's why we see that going on. I mean, a lot of times when people are asking about what do we do with fixed income, we try to point out um, that what we do probably isn't going to move the needle all that much on the return of portfolios. I mean, we're trying to do the smart thing. Every basis point matters to us in terms of risk-adjusted return. So we want to do the best that we can. But at the same time, we recognize that what we're doing in fixed income is very basic and probably isn't going to move the needle dramatically in terms of the risk-adjusted return that we get. And, another thing that we tell investors is, like, there's part of us that would just feel that TIPS are the safe asset and that the whole fixed income bucket should be TIPS. But we just know that that's too extreme of a view. And that's why we like having this blend between bills, TIPS, and nominal bonds as well. But we do have this. We are very partial to TIPS, as we've written about in a bunch of places. That ultimately the only thing that our wealth is for really is to spend it over time, and so we should really care about the conversion of our wealth into consumption and spending or giving it away. And so, treasury bills are kind of more risky in that sense than TIPS are, because if what we're concerned about is our long-term real consumption stream that our wealth is equivalent to, then TIPS are kind of a lower risk asset than bills. But, we don't get too carried away, but that's kind of what's in the back of our minds a little bit.
It's funny how you can almost always tell when we have new conversations, you can almost always tell how someone found out about Elm, because if they read the book, they will say, "Why do you have anything besides TIPS?" And if they haven't read the book, they'll say, "Why do you have TIPS?" And you can kind of figure out where someone's coming from generally based on that question. Shifting gears a little bit, James, question for you from Alex. If you could speak a little bit about how we think about the granularity that we have in the U.S. equity bucket versus the granularity that we have in the non-U.S. bucket. Specifically, if there would ever be a way to kind of break out the non-U.S. bucket into further sectors or country-specific instruments.
Yeah, so this is something we keep an eye on pretty regularly. We generally like more granularity. It gives us more signal diversification. It gives more tax loss harvesting potential. Um, we within the last year or so, started offering the ability to break up the broad US market into each of the underlying sectors. And we apply an individual momentum signal to each of those sectors, though we do not apply a sector-specific valuation signal. And the reason we don't is we believe that the logic through which PCAPE is a pretty good forecaster of long-term expected returns holds at the broad market level, but as you get closer to the single stock level, it doesn't hold anymore. And sectors are somewhat in between. But when we break up the U.S. into sectors, we use just the broad market valuation signal, and then we use individual momentum signals. Um, something we do look at is breaking up emerging markets into constituent economies. Um, China is the biggest constituent of EM right now at about 30%. With India not too far behind. And if there were large, liquid, very low cost India and China and EMX India China ETFs, we would probably use those. We would probably break it up. And when and if those ETFs come along, we'll certainly seriously consider using them. Right now, the market specific ETFs are not as large, liquid, and low cost as we would like them to be. And we view that the extra benefits from more granularity don't right now outweigh the extra costs. But that's something we look at every year. Sometimes more often. What new ETFs are out there, what ETFs are lowering their fees, what ETFs have grown, and so having more granularity is something I could definitely see us having in the future, but it's just going to depend on the evolution of what good ETFs are out there.
Victor, I think maybe we can do like one more question, and then if there are any questions in the chat, maybe we can kind of wrap up with some rapid fire there. If you could maybe talk a little bit about a question that we get all the time in some form or fashion, talking a little bit about U.S. Two things about the U.S. market. One, concentration of the kind of large tech stocks in the various indices, and then also how we think about the composition of the global market cap with U.S. kind of continuing to be larger. I saw recently that the U.S. tech stocks are the size, have the same market cap weighting as almost all of Europe right now. So you could talk a little bit about that versus the rest of the world, how we think about that, what our general perspectives on that, how we kind of talk to people about it, and kind of these regular conversations that we're having.
Yeah. So I think that the concentration of the big names in particular in the U.S. index, it's certainly unprecedented in the last 3 decades. It's not unprecedented, of course, going further back than that. There's been big concentration. We wrote about this a couple of years ago, where we pointed out that, the concentration looks big, but at the same time, especially when you take a global perspective, that the weight of those big companies, is such that they should get some extra, they do need some extra return to kind of justify the risk of holding these big concentrated slugs in our portfolios. But it's not that much. Maybe there's some point where one would get concerned. I mean, certainly in Canada in 2000 or so, the main telecoms company in Canada represented like 50% of the Canadian stock market market cap, and that was a pretty disturbing sign overall. And if we had one company that somehow became 50% of the U.S. market, I think we'd be concerned about that and really be thinking about whether that's a sign of something that's kind of gone amiss in terms of market dynamics. So anyway, I think that we're relatively comfortable that the market more or less is getting the stock picking side of things reasonably sorted out, and in any case that we don't really have a view that we would put more weight on than the market's view on what the valuation of different stocks relative to each other should be. So we don't think that stock picking is something that we're good at. We don't think it's something that many people are good at. And as we've pointed out when we talk about our risk matters hypothesis, that stock picking not only needs to beat the market, but it needs to beat the market by the extra risk that you're taking by doing stock picking, and that somebody else is on the other side of you and they also need to beat the market. So it's a negative sum enterprise, even to the extent that there are no extra fees involved in trying to do stock picking. In terms of global market cap, we try to Uh, we try to be somewhat protected against, craziness in the global market cap setup. I think that one thing that is kind of baked into the way that Elm has set things up and thinks about things is the experience of late 1980s Japan. Japanese stocks in the late 80s got to a point where they represented something like half of global market cap. And so we tried to build Elm in a way where, if something like that happens again, that we wouldn't be slavishly having half of our equity exposure in Japanese equities, by just saying, okay, we're just going to go with some global market cap, just take some global market cap, and that's it. So, when we build our baseline exposures between US, non-US, between US, Europe, EM, Asia developed, et cetera, we're not just using what MSCI and FTSE come up with. We're also trying to inject a little bit of reality into that by taking account of such things as GDP of the different regions and also the earnings that are coming from the public companies in those different markets. So we lean against it a little bit, but at the same time, the U.S. at the moment is just, I mean, is that we're not far behind what when we do all of that, we still are not too far behind where FTSE and MSCI are kind of coming out on those weights. For US investors, we're building in a little bit of US home bias. For non-US investors, less so. And so, in our non-US investor portfolios, the relative weight of US versus non-US is a little bit lower US than what we're doing for US investors. But yeah, I mean, it is a remarkable place that we are right now. We think that we have some understanding of the forces that are driving it. While we may understand those forces, we don't know when they're going to abate. The U.S. Exceptionalism, the U.S. home bias doesn't leave room for other investors in the rest of the world to own U.S. equities, pushes things up. U.S. companies doing stock buybacks at a much, much higher rate than companies do in the rest of the world. I mean, U.S. companies are buying back over $1 trillion of their stock each year. That's like $40 billion of buying every day that companies are doing. A number of these different, factors are causing this. But we think over the long term, that the way we're managing portfolios is taking account of these things and doing the best and positioning reasonably for whatever happens down the road.
Victor, James, any parting thoughts here? And certainly, I know there are a few questions that we didn't get to, and obviously, feel free to shoot us a note. We'll make sure that we get everything kind of sorted over there. But any parting thoughts on the way out?
We've the one thing that we do is when we get questions, and the more that we talk with all of you, the more that we see what are the things that people are curious about or want to know about what we're doing, and we're adding. Not a ton of them, but we're adding frequently asked question answers onto our website. So, it might be worth taking a look there from time to time. Like one question that we get a lot is, I thought market timing was bad, and isn't dynamic index investing market timing? And so we have a fact that tries to explain, what we think people mean by market timing and why what we're doing, isn't that. There's a discussion about momentum, why we use momentum as a risk metric rather than volatility directly in our facts. So, yeah, do take a look at our facts. But moreover, please do keep asking us questions, because that's really so valuable for all of us. I think that having such a great investor group of knowledgeable and curious people has helped to make what we do better, for sure. I think it's to the benefit of all of us. So please do continue to ask us questions and interact with us as much as you feel like.
I will leave everyone with a few things that we were sort of outside of our investing focus. There are a couple of things that we were really excited about towards the end of last year. Starting with the crystal ball game that had kind of been an ongoing game on the website for a few years. And when we published the study, we had a really, really fun reception. across a lot of different newspapers and people writing about it in a really funny way, which was really fun. And then a lot of folks who were probably on this call were also joined us at an event in October where Victor and James did a panel with Professor John Campbell to kind of talk about household finance and some of the things like that. And then lastly, if you haven't heard about it, you will continue to hear about it. The paperback copy of The Missing Billionaires is in newsstands now, or hopefully to be in newsstands now, but it's certainly on Amazon and maybe hopefully coming to an airport kiosk near you if we play our cards right. But yeah, it's a little thinner. It's a bit more portable than the hardcover. So I don't know if you're on the go, if you're a commuter, this could be a good option for you. We'll leave you with that. Thank you everyone for making the time with us today.
Thank you.
Bye, everyone.
Bye.